What compels an increasing number of young people in China to gamble their financial futures by taking on substantial debt to trade stocks? Is it sheer ambition, a quest for quick wealth, or something deeper driving this risky behavior? As we explore the intricate motivations behind these choices and their far-reaching consequences, we uncover an intertwining of ambition, speculation, and debt that not only jeopardizes individual lives, but also shakes the foundations of the broader financial system. The alarming trend of Chinese youth borrowing to trade stocks raises critical questions about personal well-being and the stability of the economic landscape they inhabit. So stay tuned for this video to delve into more about this. But before we begin, please take a moment to like and subscribe to our channel, China Fact. Thanks a lot for your support. The recent bull market in China's stock market has drawn in many young investors. One college student joined in, but soon saw her stocks plummet, leaving her feeling stuck and crying. She expressed, "I feel like it's the end for me, my entire life is ruined. I won't be able to recover from this. Today I woke up to a loss of over 10,000 yuan. That's several months' worth of my salary. How long will it take me to earn that back? Yesterday the market seemed promising, and I thought today might show some improvement. Everyone was predicting a low opening followed by a significant rise. I planned to sell in the morning, but then I hesitated, thinking the market might rebound in the afternoon like it did yesterday. Many others were saying the same thing, so I held off. Now it seems like the losses just keep coming, and all my stocks have hit their lowest point. I can't even sell them. I'm at a loss for what to do. My losses just keep getting worse." China's stock market has experienced a sharp volatility. After increasing for 2 days, it suddenly went down. The younger generation, who are known for avoiding mortgages and car loans, turned to the stock market. Unfortunately, many found themselves in losing positions shortly after investing. On October 9th, when the market dropped, young investors who bought at the peak of 3,700 expressed their frustrations on social media. One young man said, "I've been deceived again, lost money again. This is insane. If I continue to trade stocks, I must be foolish. Let me tell you, this market was supposed to be full of opportunities. It's because of this immediate benefit that I recklessly invested a large sum of my savings in it. But now I'm all lost." After the October break, a fresh group of investors joined the market, including students. Some utilized the money they earned from their summer jobs, aiming for fast gains, but ended up experiencing significant financial setbacks instead. A third-year female university student shared that she hadn't been able to sleep for 2 nights. She blocked all her family and friends on all social platforms. A few days ago, she had promised not to get involved in the market hype and to stay steady. However, many like her secretly added more money, hoping to make extra gains for a sense of security. She had thrown in all her private savings, watching the stock drop more and more, feeling like a complete joke. She didn't even dare to check what was happening that day. So these inexperienced young investors entered the stock market with high hopes, but the market's downturn following the National Day holiday delivered a harsh reality check. For many years, China's stock market has led to significant financial losses for investors. Since initially hitting the 3,000-point mark in 2007, this market has faced challenges in gaining momentum. Despite occasional spikes to 4,000 or 5,000 points, it has often experienced subsequent crashes. Critics argue that the market is controlled, with collaboration between the Chinese government and unscrupulous companies to mislead investors. Retail investors have been viewed as vulnerable targets for more than 3 decades. Earlier this year, China's Security Regulatory Commission implemented changes aimed at stimulating the market, with the intention of generating a bull market, even if it required artificially increasing prices. On September 24th, regulators unveiled additional economic incentives, such as interest rate reductions and cash infusions, leading to a rapid market upturn. This surge in market activity attracted more investors, some of whom utilized low-interest consumer loans to amplify their investments. Brokerage firms experienced a surge in new account applications, while industry experts contributed to the excitement by proclaiming the arrival of a bull market. On September 30th, there was a significant increase in the market, with numerous stocks reaching their daily limit. Following the holiday, the market experienced a notable decrease in value upon reopening. October 8th saw an initial surge in the market, followed by a sharp decline, resulting in the highest single-day trading volume of nearly 3.5 trillion yuan. The following day, October 9th, the market once again experienced a drop, with many stocks reaching their daily lower limit. On October 10th, the market displayed mixed performance, initially dropping and then slightly rebounding. October 11th witnessed another significant market plunge, leading to widespread despair among investors, particularly young ones who took to social media to express their grievances. Many are recognizing too late that they have been ensnared. Some think the government orchestrated the market rally to transfer debt to middle-class investors. Ironically, it was the younger generation that bore the brunt. Even more astonishing is that many of these young investors were trading with borrowed money. Most of them, barely in their 20s and without a steady income, used platforms like Huobi and credit cards to borrow substantial amounts of money for investing in the stock market. As per some sources, even though the market was closed during the National Day holiday, the number of new brokerage accounts reached a record high. More than 70% of these new investors were born in the 90s and 2000s. On social media, discussions about borrowing to invest have increased. Some users are contemplating taking on more debt, spurred by low interest rates. Meanwhile, others were eager to jump into the market as soon as their loans were approved. According to financial experts, the rise of financial apps has further simplified the process, enabling seamless borrowing and trading in just a few taps on a smartphone. In some cases, loans are structured specifically for stock trading, further amplifying the risks. Before the holiday, banks heavily promoted consumer loan deals with interest rates as low as 1.8%. There were even special loans for investing in the stock market, which fueled a lot of excitement. A manager at a state-owned bank mentioned a notable increase in loan applications before the holiday, as many individuals were interested in entering the stock market. An insider from a bank disclosed that over 7 billion yuan in consumer loans were issued during the holiday, surpassing the amount issued during the Lunar New Year. Banks are currently dealing with a large number of loan applications, primarily from young investors. The recent volatile market fluctuations have resulted in many new investors being trapped and experiencing significant financial losses. One investor expressed their frustration by saying, "Just as our investments were beginning to show growth, we faced sudden losses." Disappointed young investors are now writing open letters targeting stock market manipulators. They argue that the current stock market surge is a matter of national significance and claim that we, the younger generation, are like crops awaiting harvest. However, we are patriotic and committed. In our group of over 20 individuals, all born after 2000, we have collectively invested over 10 million yuan. We are delivering a clear warning to the capital markets: do not underestimate us. Our funds come from credit cards and online loans. If you attempt to cut us, we will not repay. Let's see who's really the crop. Banks are becoming worried about young individuals borrowing money to invest in stocks. Lately, many banks have issued alerts stating that borrowed funds should not be utilized for stock trading. In light of the increasing practice of young people taking out loans to enter the stock market, banks have started contacting borrowers to request loan repayments. The intended target was the middle class, but unexpectedly the arrow hit a group of heavily leveraged young investors. Following the holiday, banks and loan platforms are experiencing heightened stress. Prior to and during the holiday, there was a significant increase in loan requests. Initially, banks anticipated profiting from the interest, but now they are concerned about potential losses of the principal loan sums. There is speculation about whether these young investors will default on their loans if they incur losses from stock trading. The mindset of the 2000s generation is straightforward. If they make money, that's great. If they lose money, they simply won't repay. They are unconcerned about not being able to afford high-speed train or plane tickets. Many in this generation believe that if a bank offers them a loan, they should be prepared to take on the risk of non-repayment. Some express the view that they are not really taking a loan, but rather selling their creditworthiness for money. Others plan to buy stock from the company they borrowed money from, and if they incur losses, they will use the stock to repay the debt. When it comes to the risk of damaging their credit, these young people are not too worried. They feel that bad credit won't affect them much, as many of them do not plan to get married or have children. Their attitude is essentially, we're not afraid of being cut down. If you cut us, we'll cut the bank. I'm holding the bag for the country, so the bank will have to hold the bag for me. When the situation deteriorated after the holiday, the government swiftly intervened, prohibiting the entry of bank loans into the stock market. If these loans go unpaid, bad debts will rise, potentially leading to bank failures and a financial crisis. The generation born in the 2000s is proving to be a formidable force, catching banks off guard. As a result, regulators are now working urgently to prevent bank credits from entering into the stock market. On October 8th, a media outlet affiliated with the central bank reported that financial regulators had instructed banks to prohibit credit funds from illegally entering the stock market. Following this, more than 30 rural banks and credit cooperatives issued warnings stating that credit funds should not be directed towards stocks, bonds, futures, or wealth management markets. They also mentioned that any credit funds discovered in these areas would result in early loan recalls. As a result, banks have become more careful about lending. They're inquiring borrowers upfront about the purpose of the funds, which has made it more difficult for those who genuinely need loans to access them. The young investor Yair borrowed money to trade stocks on October 8th. She made a significant investment, but by the close of trading on October 9th, her account showed a loss of 16,000 yuan. After experiencing days of emotional highs and lows, Yair acknowledged that she had been driven by emotion. She had borrowed 280,000 yuan, the largest sum she had ever handled. Seeing her daily losses exceed her monthly salary left her in shock. She regretted rushing into the market. Yair explained that she originally had 300,000 yuan from her parents to buy a house. The money was tied up in a fixed-term financial product, but the market wouldn't wait, so she used the product as collateral to borrow 280,000 yuan. Losing all of it would hurt her family, while a 30,000 to 50,000 yuan loss might be manageable. Yair expressed concern about facing her mother's wrath if she found out about the situation. Yair advised new investors not to borrow money to trade stocks, emphasizing that protecting your funds is the most crucial thing. Retail investors face a disadvantage in terms of their knowledge, information, and financial resources, which contributes to the heightened emotional volatility in China's stock market. Their lack of risk awareness, erratic decision-making, and limited expertise often result in significant losses during market fluctuations. The confidence that retail investors had before the National Day holiday has now dissipated. As retail investors withdraw, major shareholders and institutional investors are also exiting the market. From September 24th to October 11th, 172 listed companies announced plans to reduce their holdings. Among the numerous young investors who suffered losses money, one of the hardest hit was a second generation named Here, who was one of the first victims of this market frenzy. During a live stream with the vlogger called Little Lamb Who Loves Finance, Hare disclosed that he had invested 83 million yuan of his own money, leveraged it to 250 million yuan, and entered the market on October 8th. On that day, he suffered a loss of 13 million yuan. By October 9th, his losses had surpassed 100 million yuan. He shared that if things didn't improve soon, his initial investment of 83 million yuan could dwindle to only about 200,000 or 300,000 yuan. He added that the villa, large apartments, and 20 commercial properties he had used as collateral could all be at risk. He also worried about the possibility of losing 3 generations' worth of accumulated wealth overnight. He admitted feeling overwhelmed and unsure of how to explain the situation to his family. Enchanted by the appeal of the stock market, he watched as his investments rapidly dwindled, leaving him in significant debt. While his family had amassed wealth through real estate, he found himself captivated by the stock market and became deeply involved. Initially, he heeded the guidance of a supposed stock market expert from Shanghai and put 5 million yuan into investments, only to see the stocks continuously decline. Unable to endure the losses, he sold it at a loss. Subsequently, the stock experienced a sudden surge, leaving him feeling enraged. In September, widespread rumors suggested that the stock market would experience a significant increase. Prior to the holiday, he invested all of his money in the market, anticipating substantial profits afterward. However, within a short period, he became stuck in a difficult situation, almost being compelled to sell off his assets by the leverage trading company. Experts say the trend of young individuals borrowing money to invest in stocks is on the rise, but it comes with substantial potential risks. Mr. Wang, a Chinese businessman, remarked that the Chinese Communist Party was taken by surprise by the young people borrowing from banks to invest in stocks. Some of these young investors said, "I maxed out my credit cards and online loans. I'm betting on everything. If I lose, it's your money, not mine. Don't expect me to repay it." It's as if everyone borrowed from a wealthy individual, who then pushed the market up. When everyone rushed in with borrowed money, the wealthy individual was left stunned. He intended to reap a profit, but instead, the borrowed money was reinvested back into the market. Mr. Wang has a pessimistic view of the future of China's stock market. He expressed doubt about the market's stability, citing the 2015 surge followed by the crash in 2016 with no recovery since. Despite the government's efforts to support the market, such as using pension funds, they have not been successful. Prior to the holiday, the government attempted to bolster the market, but there has been a significant outflow of foreign investment funds, amounting to hundreds of billions. Economists recently published an article cautioning that when market sentiment is elevated, investors should be wary of a sudden crash. They emphasize that a gradual wave-like bull market driven by economic fundamentals is more beneficial for investors in the long run, as opposed to sudden and drastic fluctuations. In conclusion, the recent surge in China's stock market has revealed the precarious position of young investors who, driven by the allure of quick profits, have plunged into trading with borrowed money. This phenomenon not only highlights their lack of experience, but also raises concerns about the broader implications for the financial system. As many young investors find themselves trapped in a cycle of emotional distress and financial loss, the consequences extend beyond individual hardships to potential risks for banks and the economy at large. Additionally, the government's attempts to stimulate the market may have inadvertently encouraged reckless behavior among inexperienced traders, leading to a volatile environment where significant losses are common. The sobering reality is that the dream of financial independence through stock trading can quickly turn into a nightmare, underscoring the need for better financial education and responsible investing practices. That's the wrap for today's video. Thank you for watching. If you found our content engaging, please give us a thumbs up and share it with your friends and family. Don't forget to subscribe to our channel, China Fact, and turn on notifications to stay current with all our future uploads. Your support is incredibly important to us. Until next time, take care and goodbye.